Well, look, if there is good news to support more interest rate cuts from the Reserve Bank, it's that wage rises are slowly drifting down. The wage price index released today was up by 3.2% in the year to December 31. In the year to September, the wages rose by 3.5%, and in the same quarter last year by 4.2%. Now, for the quarter, wages increased 0.7%. That's the lowest quarterly growth since March 2022. Private sector wages for the year, 3.3% higher. For the public service, 2.8%. Now, if wages inflation is easing, it makes the job easier for the Reserve Bank to justify cutting interest rates later this year. One man who consistently forecast the Reserve Bank would cut in February as it did is the Commonwealth Bank's head of Australian economics, Gareth, who's with me now. Gareth, many thanks for your time.
Thanks, Ross.
Were you satisfied by the Reserve Bank's decision yesterday?
Well, satisfied is one way you can look at it, but ultimately I think they did the right thing and the thing that we thought they would do, which is cut the cash rate. The inflation data has looked pretty good more recently. Policy is currently restrictive. It's still restrictive after the rate cut that we got yesterday. That's what the Reserve Bank board explicitly said.
Were you happy about the noise and the politics that clearly went around that? I mean, that, as I said, was the most anticipated Reserve Bank decision I've ever experienced, and the hype around it seemed just off the charts.
Yeah, I agree. I mean, the hype was pretty exceptional, and I think it probably stems from two things. One is that we had quite a large window between when the Q4 inflation data came out and then when the Reserve Bank board actually met yesterday, almost 3 weeks. Within that period of time, we didn't hear any communication from the Reserve Bank, and that was really just filled with so much commentary within the media largely, and also market commentators to an extent. And then, of course, because we've got a federal election coming up, that added an extra dimension to the rate decision yesterday. But ultimately, they delivered a cut. They've commenced the process of starting to normalise the cash rate, in other words, move it away from that restrictive setting, and they'll just be guided by the upcoming data now as to what to do next.
OK, do you sense also that the Reserve Bank wanted to withdraw itself from the federal election campaign? So by having that cut, it now buys them time, and certainly to the other side of the federal election before they have to potentially take any other significant policy action?
I don't think so. I think it was just ultimately the data that made the case for them to cut. The Q4 inflation data, which we got out in late January, was quite a bit softer than the Reserve Bank had anticipated. And that actually opened up the door to cut rates in February, in December, by changing some language and essentially saying that if the data proved to be weaker than they'd forecast on the inflation front, the board would be willing to cut rates. As it turned out, it was. Policy's been restrictive. Other central banks with a similar set of numbers to the RBA on the inflation front have been cutting rates. And so the RBA basically joined in and has started to do what other central banks have already been doing, which is to move interest rates to a more normal level, because the battle on inflation is largely being won. OK,
so the battle on inflation has been largely won. There's also the employment question, because with a 4% unemployment rate, the question was whether that would stoke any wages outbreaks. Now, today we saw evidence that it's not, and we see the unemployment number come out tomorrow.
Yeah, that's right. So we'll see how that data comes out tomorrow. But I think any fears of a wage price spiral are well and truly dated now. The wages data that you referenced earlier, that actually came out a little bit weaker than the Reserve Bank had expected in their updated forecast yesterday. Also came in a little bit below where market analysts had it pegged. And the message here, I think, is increasingly becoming stronger, that in Australia we can run a lower unemployment rate than we previously thought we could, that's consistent with the inflation target. And this is a good outcome. It's looking more and more likely that we don't really need unemployment to move up beyond 4% to have inflation within the target band, and wages outcomes consistent with that. So ultimately, I think that's a good news story.
So Philip Lowe, when he was the governor of the Reserve Bank, and even Michelle Bullock have talked about the narrow path that Australia was on. They get it wrong. It seems as though the narrow path has worked. In other words, inflation is drifting lower, and yet you've maintained pretty much full employment. That is almost the perfect outcome, not only for the government, but for the Reserve Bank in its strategies as well.
Well, that's right. It's actually worked out better than the central bank themselves thought would end up happening, because if you go back to November, they forecast a peak in the unemployment rate of 4.5%, and they thought that was consistent with getting inflation back to the target band on an underlying basis. They've now lowered that peak to 4.2%. And that's basically a result of the labour market holding up better than they thought and inflation coming down more quickly than they thought.
But does it also show for the future, when you've got downturns, significant downturns or a spike in inflation, that this may be a method of not smashing your economy into recession and having lots of people unemployed very quickly, that maybe you allow it to drift and let it go. So is it horses for courses, or is this maybe a new measure as to how you manage the economy in the future?
I think it's horses for the courses to the extent it depends what you're actually dealing with here. But fundamentally, the approach that the RBA has taken has proven to be, in these circumstances, the right one. You know, I think if you told them a couple of years ago, you're going to end up with a 4% unemployment rate, and this is when we had inflation up around 6-7%, and you've got to get inflation all the way back to the target, and these are the kind of numbers that we'll end up seeing, they would have said this is too good to be true. Now, they obviously didn't like the starting point of having to get inflation down from such a high level, but it's turned out to be the case that we've been able to do that and pretty much preserve all those gains in the labour market. So unless something happens this year and the labour market does get away and they do have to cut rates more aggressively than what we think, then ultimately the strategy and that they've run is proven to be successful.
I'll tell Gareth there, always good to get your input in the program. Many thanks for your time today.
Cheers, Ross.